All right, good afternoon. Welcome here to Trader Minute. Great to have you aboard. Let's go out here and take a look at picking stocks to trade options with. Thanks, BJ. Um, Feel free to use the chat as you have questions. I know because of the time of this class, we're not going to have a lot of people attending, but this is being recorded as well. Now, when it comes down to picking stocks to use to trade options, okay, there are three things that I like to take into account. Okay, number one, the mechanics. Okay, what do I mean by mechanics? Well, does the stock have options? Does the stock have a spread that is decent? And we'll go out and we'll look at that here. Okay. The other thing here, number two, that we need to address is, hey, what are the fundamentals? Okay, is this stock likely to go up? Is it likely to go down? And number three, what are the technicals? And not from a short-term standpoint, but from a long-term standpoint in regards to these technicals. Okay, so we have these various aspects, and so let's go dissect these. I'll show you some of the basics that I look at. Some of you will say to me, well, Jeff, you bought a put on this trade when the mechanics or the fundamentals and technicals were saying, hey, maybe you should buy a call. Okay, so these are just big picture items, not necessarily little picture item, but these are some guidelines that I like to give traders in order to kind of keep them in a little more of a safety zone, keep the probabilities of success higher. Okay? Now, let's start with number one, the mechanics of trading an option. Carl talked about option chains here today. Talked about, you can take a look at the call and the put prices and different things like that when it comes to an option. Let's say, and these prices right here, they're not going to be correct because we are talking about it when the market is closed. Okay? But take a look here at this November option, and I'm going to use this little zoom it tool here so I can circle things and highlight things. Okay, but let's take a look right here at this November 22 call. Okay, the November 22 call. We have a bid price, we have an ask price. Okay, well, whenever we're buying or selling these options, in general, we are going to be buying on the ask and selling on the bid. Sure, we can go set a limit order in there and pick this up maybe for $2. But if I'm going out and buying this option for $2.09, and immediately if I decide, you know what, a minute later, I don't really want to be in this trade, so immediately I turn around and sell it, I'm selling it for $1.94. I'm losing 15 cents. Okay, in this case, I'm talking about 7% of my option value. Okay, 7% of my option value. Okay, now this is Cisco. In the morning, these spreads are going to come back. They're going to look really nice. They're going to be 2 pennies. Okay, but on some options, okay, they don't. Let's take Vulcan Materials. Okay, let me zoom in here. Take a look at Vulcan Materials. Yeah, I may think this stock is going up, but I'm buying it at $1.30 and able to sell it at $1.05. I'm talking about a 25-cent spread. I'm almost losing 20% of my value just by getting in the trade. That's a pretty steep cut that I have to pay to get into this trade. So the first thing I do when it comes to picking a stock to use to trade options, first thing that I want to do is I want to make sure, that I have a decent bid-ask spread. So just because the stock has options available doesn't mean they're really tradable. Okay, I want to make sure this bid-ask spread, the mechanics of this, are good. Because it's one thing to say, you know what, when I'm entering the trade, I'm going to go in, I'm going to try to split this and maybe get it for $1.15 or $1.20. Okay, great. Yeah, I split it. But now when I need to get out, let's say something weird's happening to the stock or it's moving really quickly, I'm not really going to have that option to split it, am I? Okay, I can't use a stop to help me split it or anything like that. I not only have to pay 25%, I have to pay 25% to get in. I'm going to have another different spread when I get out. So I'm looking for options or stocks who have options where the spreads are small. Okay, what do I mean by small spreads? I'm talking about spreads in the 2-3% range, max in the 5 to 7% range. Okay. There are some stocks out there that trade really well. That back in my fund managing days, we would trade the stocks. Kalu Aluminum is one of them, where the signals work so well here on Kalu. It trades a very easy stock trade, or it was in the years past. But we could never really do the options because the spreads were way too high. It didn't make any sense to go after those options because we needed a big move for those options to pay off. Okay, and I didn't always want to bet that I was definitely going to get that type of big move. So that's parameter number one. Okay, parameter number one, and perhaps the easiest there as far as the mechanics. Parameter number two, the fundamentals. Okay, the fundamentals. And I'm going to skip that one for now. I'm going to go on to number three. Okay, and we'll come back to the fundamentals, but the technicals. Okay, when I first started trading, I learned a lot of stuff on my own, but there was a buddy of mine. He showed me some things. He was a pretty good trader. He focused a little more on day trading than what I was comfortable with, but he showed me a few things, and I remember this lesson that I took from him. And he pulled up a chart, and he said, Jeff, and let's take Home Depot, okay, just for kicks and giggles. And the chart had none of the indicators on it. Okay, it was it was a blank chart, no volume, no anything, and on his charting software. And he said to me, Jeff, take two indicators. Okay, take a simple moving average of 50 days. Take a simple moving average of 200 days. Okay, excuse me, 100 days. Okay, 100 days. Okay. Take these two simple moving averages and put them on your chart. And he said this. He said if the 50-day is trading above the 100-day moving average, look for excuses to buy the stock. Or in other words, buy call options. If the 50-day is below the 100-day moving average, look for excuses to sell the stock. Okay. Now, a lot of people look at the crossover points of major moving averages like this. In my book, they don't mean a whole lot. Okay. But when we're talking about a 50 trading above a 100-day moving average, the stock tends to have an upward bias. So buying dips or looking for excuses to buy it makes sense. Once we start to trade where the 50 is below the 100, it doesn't say the stock has to go up or down, but looking for excuses to sell the stock in general are going to be a little bit more profitable. Okay. Now, he took the 50 and the 100. One of the things we do for the vibe is we take and we slap on a 200-day moving average. And we say, look, if the 50 is trading above the 100, which is trading above the 200-day moving average, these are in a tied up position. And Carl talks about those every day in his top three. Okay. If the 50 is below the 100, like it is right now, and both of these are below the 200, you're looking at reasons to sell the stock. Okay. There was a stock this week that triggered a very nice bullish signal. And I just absolutely cringed at it. I just couldn't go and feel comfortable getting aggressively long with it. It's potash. Potash broke out, started trading above, about 32.80, setting a new short-term high here. And he's had some pretty bullish signals with this Dragonfly doji and some other things. But bottom line, look at the 200. The 200's sloping down, and it's above our 100, and it's above our 50. Overall, our major moving averages are what I call tied down. I'd rather look for an excuse to sell than a reason to buy. Take Starbucks. The opposite picture, right? 50-day rising, 100-day rising, 200-day rising. These are tied up. I'd rather look for an excuse to buy Starbucks. Yeah, maybe I have a sell signal or something like that, but I'm probably not going to trust that sell signal too much. I'm really going to, I'd rather trust a buy signal than a sell signal. This can be one of the easiest ways for new traders to say, you know what? Look, I'm looking at this stock and I want to trade it. Look for an excuse to get a call or look for an excuse to get a put. Just look at these major moving averages. Why? Well, yeah, these major moving averages can shift and move, but in general, something that's tied up will stay tied up for a long time. Look at how long Starbucks has stayed tied up. Okay? Let's say you made a mistake. Let's say you bought Starbucks right here in August. Okay, I'll zoom in. Let's just say you bought it right here. The stock went down on you. You're sitting there going, gee whiz. I have a good company. It's in a good trend. Moving averages are tied up. Well, you have a lot better chance of that call option coming back for you when your moving averages are tied up. Okay? You make a mistake on a put option in this case, well, you have a lot better chance that put option goes worthless on you because of the overall trend. Okay? Some traders out there will say trade the trend. Okay, I like trading the trend, but there are times where you're dealing with stocks that don't have a trend. Okay, but you're new to trading, you're just starting out, you want to say, you know what, I want to be in the best probabilities possible. Trade calls on moving averages that are tied up and trade puts on moving averages that are tied down. Okay. All right, so that's simple from a technical standpoint. Now, let's get into the third aspect and the aspect that I pay attention to the most outside of the mechanics, right? Well, I'm coming here to a website called Finviz, okay, finviz.com. Okay, finviz.com. And you could do this type of analysis at a ton of websites. Yahoo Finance, Google Finance, Money Central, Investors Business Daily. There's a ton of them you can do it at. Finviz.com is just one I've grown comfortable with. Let's take a stock. Let's take Starbucks. Okay, let's stick with the Starbucks theme. I just put the ticker in up here. And what it's going to do is it's going to give me a whole bunch of data down here below. Okay? It's going to give me, from market cap to dividends to book value, earnings date. It's going to give me more data than I really want. Okay? But, and let me bring up here, zoom in here for us at the data that I want. Okay? There are 4 numbers that I'm really interested in. PE and forward PE. Okay. A PE ratio is basically the price of the stock divided by the earnings per share. Okay. Price of the stock divided by the earnings per share. And for years, fundamental analysts have used that number to kind of give a normalized value to a stock. Okay. If you go track PE ratios and stock performance relative to what their PE ratios are, you're going to find very little correlation. In fact, most market participants realize that looking at PE ratios is a futile endeavor. Okay, it's not going to give as much in and of itself. Okay, in and of itself. But when we look at a PE ratio and compare it to, the earnings per share, okay? The earnings per share. So if I bring in this box right here, we have the earnings per share this year and earnings per share next year. And we have a percentage growth, how much they're growing, okay? How much they're growing or shrinking. Okay? While these two numbers really have nothing to do with each other, okay, and in concept, there's not a whole lot of correlation here. Yeah, if you're a mathematician and you're trying to do some sort of comparison with the variables, you're going to say, yeah, there's nothing here. Okay? But one of the tendencies we find in the market, okay, is simply this. Okay, is that when the PE ratio, okay, when the PE ratio is less than the earnings per share this year, the stock tends to be in a bullish mode. When the PE ratio is greater than the earnings per share next year, okay, excuse me, let me go back and type this properly. The forward PE is greater than the earnings per share next year, okay, the stock is in a bearish mode. Okay. Now I can extrapolate some of this down. So let's take PE ratio. Sorry, I'm kind of doing this out of order here. But PE ratio being greater than the earnings per share this year. Okay, that would obviously be bearish. Okay. So let's take a look at this first comparison. Sorry, I got a little ahead of myself. Take a look at this first comparison. PE ratio. So we're talking about this year. Current PE ratio, if it's less than the earnings per share this year, talking about a stock that tends to be in a bullish mode. Why? Okay, why? Why is that the case? And then why would it be the case that the PE ratio, if that's greater than the earnings per share this year, then it would kind of be more of in a bearish mode? Okay. Well, let's think about what these things measure. Okay. PE ratio, okay, PEs are basically a measure of value. What type of value are you getting? Are you getting good earnings for the amount of money you're paying for the stock? Okay. And there are value traders out there. They really focus on the multiples. PE ratio, they'll use the term multiple. So it's really a measure of value. Okay. The EPS, or earnings per share, okay, growth, what is that a measure of? Well, growth. Okay. And we have growth stocks out there. So we have stocks that trade based on their value. We have stocks trading on their growth. When we are in a situation where the PE ratio is less than the earnings per share, we're basically talking about something that has good value, okay, good value, and good growth. Okay, we're getting the best of both worlds here. When we're talking about something where a PE ratio is greater than the earnings per share this year, we're talking about something that, hey, maybe that value is a little bit expensive for the amount of growth that it has. Okay? And one of the things about Starbucks, if we look here at the value and growth, look at the PE ratio. It's up here at 36. Look at the earnings per share this year at 26. This is a pretty good earnings number. Ooh, this is a pretty high PE ratio. Most PE ratios are under 20. You don't see a lot getting up this high. But what's this saying? Starbucks has been on an amazing run. But it's getting to a point where, its value and growth comparison don't look as good. They just don't look nearly as good. For much of the year, back since January, even into 2012, the PE ratio for Starbucks has been below the growth number. And we've seen Starbucks continue to climb. Now we're starting to see the PE ratio catch up and trade above the earnings per share number. We're seeing Starbucks plateau a little bit. Okay, yeah, it may still have a little bit of upside, but it's not one that I'm as anxious to look for an upside trade on. Okay? Now, we did this comparison with the current PE and the earnings per share this year. Fine. I could care less about those two numbers. What I want to do is I want to go and look at next year, right? The market's forward looking. You know, what's happened is past, and the market says, okay, fine. Okay. But let's just make the same comparison now using the forward PE, which is basically bringing into account earnings for next year, and let's look at the earnings for next year. Let's take a look at this comparison. Okay? So our forward PE is at 25, and our earnings per share next year is at about 20, right? Not as bad as the comparison as the current year. Okay, not as bad of a comparison, but it tells me, you know what? For the amount of growth Starbucks has, it may not have the explosion that we've seen in 2013. Okay, yeah, Starbucks could still go up, right? But I'm not going to expect Starbucks to go like it has from 55 to 80. I'm not going to expect another $35 rise out of Starbucks until we see some better growth come in there. Okay. Or we see Starbucks pull back, because what will happen if Starbucks pulls back and has a sell-off down towards 70? What's going to happen to this forward PE? Well, the earnings aren't going to change, but this forward PE is going to drop, maybe down to 15, 16, 17. Well, at that point, our comparison starts to look really good. And so, hey, Starbucks would be a pretty nice buy here at 70. Okay, will it ever get there? Maybe, maybe not. But this comparison helps me to understand, you know what, up here at 80, I'm asking a lot to say this is going to rally to 90. I'm really asking a lot. Okay. Let's take potash, right? We talked potash. We had the 50 and the 100 and the 200-day moving averages all tied down. Let's look at it from a fundamental standpoint. Okay. Well, look at the PE ratios. Forward PE, they look pretty good, right? They're not too bad. They're relatively low. They're a lot lower than Starbucks, right? A heck of a lot lower than Starbucks. But look at the growth. They're not growing. They're contracting. And it's why we're seeing potash fall while Starbucks is going up. Even though Starbucks may be a little overvalued, well, this is way overvalued from a PE and a growth standpoint. We have no growth here. Until potash starts to show growth, investors are probably going to be very leery of it. And so what do I want to do? I want to look for reasons to sell, not necessarily reasons to buy. Okay. Let's take another stock here. Let's take Tesla. Okay, whoops. I apologize. Typed that in the wrong box here. Let's get it here on Finviz. Let's take Tesla. Let's look at these numbers. Tesla's been on a tear. In fact, I'll zoom back out so you can see what the stock's done. Stock's gone from 40 back in May, and now after pulling back almost $50 here, Tesla's still at 138. Okay, so yes, it's come down a lot, but it's still up big. Okay, why? Why? Why would that be the case? Okay. Well, look. Take a look at the PE. There's not a PE. Why? Because earnings have been negative. If earnings have been negative, you're not going to have a PE ratio. But what's happening? Well, we're getting a forward PE, so that must mean we have positive earnings. Yep, earnings per share this year, we lost money. Next year, we're expecting to make money. Now, when you go from losing money to gaining money, sometimes this earnings per share growth is exaggerated in a big way. Okay. But it's why a stock like Tesla can have such an incredibly high PE ratio. When you look at the market, when market average is sitting around 17 and 18, and you're talking about a stock that's at 90 and it keeps going up, why is it going up? Well, because overall, you're talking about major upcoming growth. Investors are buying the growth and they're willing to overpay or overpay from a value standpoint for that growth. So this little comparison between value and growth, and I prefer to use forward PE and earnings per share next year. But this little comparison is what kind of can say to you, you know what, this stock may have some upside, or you know what, maybe it's getting a little overheated. Let's take Halliburton. Okay, Halliburton has gone from 38 up to 55, been on an amazing run, and can it go higher? Can it go higher? Well, let's zoom in. Let's look at the numbers here. Look at the forward PE. Look at the earnings per share next year. Our forward PE is less than our earnings per share next year. We have a very good forward PE. We have very good earnings per share growth next year expected. I have a hard time shorting Halliburton. Halliburton, even when it has bearish signals come into it, to be short it more than 1 or 2 days is tough. To look for an excuse to buy Halliburton because of these fundamentals, much easier. Your probability of being right on the trade is much greater. Even though the stock's already up big. If you're strictly dealing with technicals, you're going, man, this stock's gone from 40 to 55, and that's one of the biggest runs that it's ever had. I don't know if it can go any higher. It's at the top of the chart. How much higher can it go? From a technical standpoint, you're sitting there asking yourself those questions. From a fundamental standpoint, you're sitting there saying, you know what? We have room to keep going. We have room to keep going. Let's take a look at Bank of America. Look at the forward PE and earnings per share next year. Okay? And the forward PE and earnings per share next year. Which side do I want to find an excuse to play Bank of America? Okay, to the upside. Even though Bank of America has gone up big, even though there's trouble perhaps. Do I want to go buy it today? No, not necessarily. But do I want to look for an excuse to be a buyer of Bank of America rather than an excuse to be a seller? Yeah, absolutely. Absolutely. Okay. Just based on forward PE and earnings per share next year. Now, this isn't foolproof. There will be anomalies. There will be times where you look at these comparisons and say, you know what, the stock's going the other way. But in general, the stock will follow these comparisons. Okay. Now, you can just shove through a bunch of charts, ticker symbols, and find stocks with these comparisons. But you can also come up here on FinViz and click on the screener, and you can come in and you can screen for these. So you can come in and say, let's take a look at forward PE. I want anything that maybe lower than 15. Okay, throw a number in there, and you'll see it sorts it down here. We have 1,300 stocks left. Okay, that number in and of itself doesn't mean much, but let's look at the earnings growth. Okay, earnings growth next year. Okay, and we want that to be over 15. Okay, so our PE in this case is lower than our growth rate. That's a bullish situation. Well, we have 622 stocks here. All right, well, we want stocks that we can trade options with. All right, well, let's come into the screener. Do we have anything that says option? Yeah, optionable. We can come in here and say we just want these stocks that are optionable. Well, we want to have good options for these, so we're probably looking for stocks that trade perhaps in the S&P 500. Okay, the S&P 500. And now we're down to 59 stocks. Okay, we're down to 59 stocks. Notice Bank of America in here. Okay, notice Bank of America and many others in here. Well, these are stocks that, in general, we're probably going to want to have a bullish bias. Obviously, we need to do a little bit more homework, and they may not be perfect, but in just finding a group that say, you know what, let's take Baker Hughes. Generally, if I'm looking for an excuse to buy, I'm going to be right relative to looking for an excuse to sell. Okay, in general. Okay. Now, you throw on your 50 and your 100-day moving average on that, look for tied up or tied down, and add that. Obviously, it'll sort it out a little bit better for you. Okay, it'll sort it out a little bit better for you. But this is one way to pick and track them. Now, one of the most common questions I'm asked is, how do you keep track of all your stocks? Okay, well, I have a notepad. I'm old-fashioned pen paper. I track them. Basically, I have so many tickers swimming around in my head from so many years of trading. I have scratch paper, and I'm tracking various things and whatnot. And it's a lot of time. It's a lot of work. It's a lot of energy. And you can simplify it, right? You can come in and on a lot of different websites, even your broker, right? Now, if I just come in here to Thinkorswim, I can come in and I can create various chart lists here. Whatever broker you're using, Trade Monster, has great stuff for putting various ticker symbols in and creating watch lists. Okay, and whether you want to do it pen paper, do it through your broker. You can do it here on FinViz. You can create a free account and just come up here to portfolio and create a portfolio and track those stocks in it. Okay. One of the things that you'll find if you just create a portfolio and you track the performance of these stocks where the PE is less than the growth rate, and you track them over a 52-week period, you're going to find that they strongly outperform stocks whose PEs were greater than their growth rate over the coming 52 weeks. Okay. So that's just one of the real strong tendencies of the market. And one of the ways that I'd like to pick stocks and say, hey, buy calls, puts, and be on the right side of that equation. And it just increases your odds for success. Okay, increases the probability of your success there. All righty. Well, thanks for hopping on here. Any questions, please let us know. You can email me directly, jeff@traderminute.com. Happy to help you out. Or, as you're viewing the replay here, feel free to put questions into the chat system for Carl or I. We're happy to help you out there. Wish you great trading success, and we'll talk to you later. Take care.